Any views or opinions expressed in this podcast are strictly the views or opinions of the presenter. Nothing in here is the view of the firms, corporations, financial entities that anybody represents. Nothing expressed here is a view of any regulator or semi-regulatory agency. All content is intended to be educational. Nothing in this episode construes specific investment advice, and if you do require advice, you should seek an appropriate advisor, be that a financial planner or a tax advisor or possibly a lawyer.
This is Jason Watt. Welcome back to the CE Drive podcast. Today's episode, a little bit of a mix here, so pay attention for what you need for CE credits. I don't believe this episode will be good for British Columbia CE credits. The BC rules say that financial planning topics are only valid if they are relevant to insurance and ANS. And I can build a connection here. I don't know, this is where I don't know how much of a fight I'd want to be in with my regulator around this. You know, you can make a connection that you have to understand trusts and have to understand probate and so forth in order to properly sell insurance. And I think that's probably valid. But on its face, the BC rules say that financial planning topics are only good to the extent that they deal with insurance concepts. So I don't know, this is probably not directly an insurance concept. Alberta, good for one life, no ANS. Saskatchewan, good for one life. Just be cautious that in Saskatchewan, again, those non-insurance financial planning topics can only comprise up to 5 of your needed CE credits. Manitoba will be good for 1 credit. Ontario will be good for 1 credit. It'll be good for 1 Advocacy or IAS credit. Good for a financial planning credit for FP Canada, professional development credit from IROC, and a tax planning credit from MFDA. All right, lots there. So this is getting us back into interview territory now. I haven't done an interview in a while, but I've got a whole bunch queued up here. So we'll talk about that, obviously, over the next little while. Lots of interviews. We've got CGIB Navigator coming up. We've got a bunch of group sort of relevant offerings. So lots here. The object for today, this kills me. I think I talked about this one before briefly on the podcast, but this is my set of headphones. You can see them here that you normally see me wearing. I left the dongle in a hotel room and I can't get it back. And I don't think it's possible. I've looked around a little bit to replace the dongle. That's the little thing that plugs into your computer. I know it sounds like a dirty word, but it's the little thing that plugs into your computer that lets your USB port pick up the headset. And it's like a $200 headset now that's useless without the dongle. So today's object is a headset. And I'm wearing my cheap headset, my $40 Logitech Walmart headset. On that note, actually, I'm curious about the blurred background. I have my background blurred now, and I'm wondering what people think about this. And the biggest issue with it is I think it looks dumb with the little place where you can see my real background between the headset and my head. I don't know how to fix that. If somebody does, I'd love to know. So anyways, let me know what you think. Blurred background, non-blurred background, you know, whatever the case is. All right. So in today's episode, I have Elaine Tindall on. Elaine's an accountant who recently completed her CFP certification. She reached out to me and said, I think we got to talk about these new trust rules. And I think it is important. Now, we're going to talk about them in the interview. I want to get into just some basic trust reporting or trust taxation rules here before we do the interview. So with trusts, I'm going to say probably 95% of the time, there's actually no tax reporting with most trusts. And in fact, as you'll hear in the interview, a lot of trusts, we don't even really know there's a trust, or we haven't thought about the fact that what we're doing creates a trust. So Elaine's going to talk about 3 different examples of that in the interview. Regardless of that, the trust then, what we're doing here is essentially we have a different kind of ownership. So normally when I own property, it's what's called fee simple. Ownership fee simple means I own it and control it. There's no distinction between my ownership and my ability to use that property. Trust ownership is different. Trust ownership means there's a different person who is the legal owner of the property, and then somebody else is the beneficial owner of the property. And we normally do this because the beneficial owner maybe wouldn't make the best decisions or can't legally own property. As Larry Wood from the University of Calgary likes to say, trust means no trust. So you would use a trust where you don't trust for some reason or can't trust that beneficiary to properly deal with that property. So I hope that makes sense. I hope we understand there. So then the taxation on this normally is really just flow through taxation. So the trust has some property that it owns and it generates income. That income, normally we're just going to distribute that to the beneficiary. We issue a T3. A lot of these trusts, though, there's no income at all, or really kind of the beneficiary's just been paying tax the whole time. We didn't bother with T3s and the beneficiary continues to pay the tax. That does happen a little bit. So the requirement for a trust to pay tax really only shows up where we have the trust keeping and retaining income, or the trust that's bringing in income and then sort of actively distributing it out to some collection of beneficiaries. So most trusts, if they earn income, if they bring in income and retain that income, they're going to be taxed at the top marginal tax rate. And trusts have a year end of December 31st, other than really graduated rate estate trusts, which have some exceptions here. We'll talk about that in a moment. But for the vast majority of trusts, what happens then is the trust brings in some income, and then if it retains it, it pays tax at top marginal tax rate. And then if it pays it out to the beneficiaries are just taxed as if they had earned the income originally. So if it's dividend income that would have a gross up in credit, then the beneficiaries pay tax on that gross up in credit, incorporating the gross up in credit. If it's capital gains income, then the 50% inclusion rate applies. It just flows through and retains that character when the beneficiaries pay tax. There are some exceptions here. Graduated rate estate is the big one in personal tax anyway. So the graduated rate estate for the first 36 months after death, one trust that's created by your will can access the graduated rate taxation. So still pay tax like a personal taxpayer, like an individual taxpayer, and it can have a year end other than December 31st, usually sometime based on the year of death or the anniversary of death, sorry. So that's your graduated rate estate trust. Only 36 months of beneficial taxation there, and then really nothing other than that. The qualified disability trust is another exception here, QDT. This is also a testamentary trust, so also created by death. And the QDT allows access to graduated rate taxation where you have a beneficiary with a disability. This is a fairly complex tax mechanism. I don't want to get into the finer points of QDT here. We might do another episode on it at some point. I'd like to see people actually using them. I don't know that there's anybody using them out there, or at least not much. So maybe if I find a real life example of one being used, I'll get that person to come on the podcast and talk about it. So yes, QDT. And then with trust, we actually have a downside to trusts with taxation. That's the 21-year rule. The vast majority of trusts used in individual planning circumstances are going to be subject to the 21-year rule. This says that when the trust comes into existence, so that's if I settle a trust today, I transfer property into trust today, then we know every 21 years there's going to be a deemed disposition of the trust assets. Fine. But then if we, that's the 21-year rule, okay? Or if you write a trust into your will, the day you die, that trust is settled, and then 21 years after death, there would be the 21-year rule would apply. So we have that deemed disposition rule. However, the 21-year rule does not apply to a whole range of trusts between individuals and their spouses, where the settler is age 65 plus. So if I settle a trust for myself, sort of to help out with my estate and retirement planning, this is called an alter ego trust. If I'm 65 plus and I'm the sole beneficiary of that trust during my lifetime, then there's no 21-year rule. If my spouse and I settle a trust together, or I settle a spouse for her, or she settles a spouse for me, or I settle a trust for both of us, or she settles a trust for both of us, this whole combination of trusts here, as long as the settler is age 65 plus when the trust is settled, there's no 21-year rule there either. But in other cases, you would have the 21-year rule. So that's even a little bit of a downside to trust taxation. I think we can appreciate then that the common mythology around trusts, that they are somehow this big tax planning tool, we can really dispel that. There are some places where using a trust can help with other tax planning outcomes. So we want to achieve some tax planning outcomes by a transfer of ownership, but we don't want to fully transfer ownership. The trust can help with that. Okay, so on that note, let's roll into the interview. Hi, I'm here today with Elaine Tindall. Elaine is an accountant, CPA, also CFP, based in Vancouver, practice in British Columbia. And Elaine reached out to me a couple weeks, I guess a month or so ago now, and we had a little conversation about the pending changes to trust rules, which is a pretty big deal, I think, Elaine.
For sure, yeah.
And that sort of led us to this discussion about coming on the podcast to talk about this. So before we get into the trust rules and what all this means, can you just give us a little rundown about yourself and your practice, Elaine?
I am a CPA, as you mentioned, in BC. I am a sole practitioner. Most of my clients are small businesses and individuals. I've been in public practice for about, I'd say, 15 years. And I recently undertook writing the CFP exam and met all the qualifications to become a CFP. And happily, I was successful. So
congratulations. Yeah, of course, that's a big deal. So I'm actually curious about a couple things on the CFP side there. I'll go down this path, I guess, because you brought it up. So so what is it that makes somebody who's running, a successful small tax practice decide to go and pursue CFP certification? It's no small effort to do this.
Well, I really just did it for fun. Maybe I'm kind of a sick person, but it was just
That's
really
the worst answer
generally.
I've ever heard, Elaine. So yeah.
Yeah, it was just basically personal interest. I really enjoyed reading personal finance articles and doing research on the stock market and investing. And it really ties into, of course, my practice as a sole practitioner. You run into all sorts of different people in my practice, all walks of life. And I was just really looking for a way to help them more. And yeah, it was just a fun thing to do.
So what would be some of the things that you picked up in there that were completely new to you?
Oh, insurance for one, definitely. I knew absolutely nothing about insurance, but luckily I do have a client who was quite helpful to me. He's an insurance guy. So I would call him and say, what are segregated funds? I had no idea. And yeah, he was able to help me. So that was a big help. So insurance was definitely a big thing.
Perfect. What about things like Canada pension plan decisions, or was that something you were pretty good with already, or do you find that
No,
added to your toolbox?
Yeah, that took some learning as well, for sure. But, I do have clients, they're of the retirement age, so I do get those questions all the time. So it was very useful to learn that because, I could actually answer their questions.
So this is something you and I haven't talked about at all, but then, I have this preference where people take salary income and contribute to the Canada pension plan and so forth. Do you have an opinion around that? Did this change how you looked at that at all? Anything you can share there?
Yeah, I would say I have that preference as well, because I think if you're taking dividends for 30 years and then suddenly you retire and you have absolutely nothing left to draw on for your CPP, you may be unpleasantly surprised as to what you're entitled to. So, but it is with the CPP rates going up so dramatically in the last few years. It is quite an endeavor, especially as a self-employed person. Now you're talking about $7,000 a year that's coming right out of your pocket just for Canada pension. That's not income tax at all. That's just your CPP. But I have read articles that later on down the road, we are expecting the amount that you'll be entitled to for the CPP will be much higher. So hopefully that's the case.
That's the trade-off. So yeah, the idea here roughly, it's going to be with no inflation, it's going to be about $8,000 by the time the reform is all done in 2025. And the trade-off there is that for the person who is 18 in 2025, by time they retire and have the full benefit of the new CPP, their CPP is going to be about 1.5 times what it would be today, again, ignoring inflation. So, yeah, so there is that benefit, but yeah, I hear this. It's, you know, when you get to an $8,000 expense for the self-employed person, I think it's going to give accountants, I know already today it's sort of a balancing act, and I think it's going to push some people towards, you know, all dividends to avoid the CPP premium. So,
yeah, definitely.
Yeah,
for sure.
I'm not a huge fan, but not a huge fan of that decision. There are times when it makes sense. I'm not saying nobody should ever do it, but
Right.
yeah, I appreciate that. I think that a lot of the listeners will find that interesting, because I know I hear this from my students all the time where they say, you know, the accountant told that person to take all dividends, and I don't think that's the right thing, but they're stuck sort of having to work with what the accountant has told the client, right? So just on that note of clients, then, do you have an ideal client for your accounting practice?
I wouldn't say so. I really take a wide variety of clients, from, you know, young people just starting out in their careers or in university, all the way up to seniors. And, you know, I know some practitioners restrict to high net worth or you know, a certain industry, but no, I have a wide range of clients.
So this is interesting with like the young person starting out in university and, you know, choosing to use an accountant for, I assume, for tax filings then?
Yes.
So how does that person sort of balance, like, would they be children of another client, or I'm just wondering how they balance the, like, that need for tax planning and then being able to pay for it, because, you know, there's a cost, right? You have value, so there's a cost there.
Yeah. Well, generally, I don't do any advertising. I would say 99% of my clients come to me from other clients. So yes, generally it's the children of existing clients, and, you know, they've seen their parents come to me for years, and here they are, 18 years old, and now it's time to file your taxes, and let's make a plan, and let's talk about what we can do for you.
This is interesting. Have you run into people like that where they haven't filed their taxes for like 4 or 5 years and now they got to get caught up?
Oh, yeah, all the time, definitely.
Okay. Is that a giant pain, or can you navigate those fairly simply?
Yeah, it's okay. I would say if you're getting up to 10 years or you haven't filed, it is kind of a pain.
Okay. The one I've seen that's problematic is the person who had self-employment income in there and didn't do their CPP remittances.
Yes, that's right. Yeah, that's a problem for sure.
Is that just a matter then of making a deal with CRA, or you just suck it up and write a check? Like, what's the solution?
Yeah, I think you just have to suck it up, and you have to file and pay the money. I mean, yeah, it is kind of a hit, but my clients, I try to keep on top of them and press on them, you know, you can't be too late. I don't like them to go many years without filing. So, you know, in my downtime, I'll be calling clients, looking at my list. Okay, who hasn't filed for a few years? And I'll call them up and say, hey, how is it going? And, you know, try and get them back on track, because, yeah, I don't like to see that at all. You know,
that makes sense.
After a certain point, CRA just arbitrarily assesses the income, and then you're stuck with what they have, but they still want you to file. So either way, you're going to be filing.
That's a fair point, right? I never thought about the arbitrary assessment at some point, because they would have seen a history of self-employment income and assume that would continue, right?
Yeah. So they pick a number, and usually it's the highest number they can come up with, and they send you a bill and say you got to pay. But then at the same time they say, but we still want your tax return. So
Okay,
you're
yeah,
stuck. Yeah.
makes sense. So the impetus for this discussion, of course, is around the new trust reporting requirements. And it's curious because this got Royal Assent, is it yesterday? I think it got Royal Assent.
Yeah. I read that.
Yeah.
Yeah. December 15th.
So December 15th, 2022, after, as you pointed out in our discussion beforehand, originally being passed in the 2018 federal budget.
Yes, that's what it looks like. It looks like this has been an issue since budget 2018, but I think things got kind of delayed with COVID and they kept pushing back the deadline, but here we are.
We are. So most of the items in what's Bill C-32 are new from the fall economic update. So that includes, for example, the first time home savers account, which I'm kind of surprised that it already got Royal Assent. I thought it was going to be a couple more months yet.
Right.
So gonna have to.
Yeah, I don't know what the effective date is for that.
Yeah, we're not going to see any institution with them, I think, until March or April. Like there's a date in there that there's an expected date.
Yeah, that's what I heard.
So
yeah.
So doesn't, I think, really matter what the effective date is until some institution rolls one out. So
Right.
I'm curious here, again, off topic, but do you care about the FHSA? Do you think this is going to make, you're in Vancouver where home buying is such a big deal. Do you think it's going to make a big difference?
No, I don't think so. And I think you've had some people on your podcast as well talking about this, and the general consensus among planners seems to be like, this is not a great tax policy, but we have to work with what we have. So what can you do? Like in terms of providing affordability for housing? No, never. It's not going to happen. But as a savings vehicle, I don't see that it's a bad thing. I mean, it's better than the home buyer's plan in that you don't have to pay back a loan at the end of it. And I would just tell my young clients, why not? Even if you don't foresee you will ever buy a house, why not put the money in? And after 15 years, if you still haven't bought a house, it just goes into your RSP.
Yeah, the way they've set it up, it does make sense to use it. I think you're right. And this is, Aaron Hector was on earlier talking about this. As much as we might not like the tax policy, it doesn't mean that we shouldn't use it, right?
Right. Yeah.
So of course, the big thing that's in there that I think is the full scope of which I think is probably not yet understood is around new trust reporting requirements. So can you give us a little rundown on what the trust reporting requirements look like?
Well, it looks like in the past, trusts did not generally have to file returns unless they had tax payable or there was a capital disposition. But at this point, it seems like they're updating that so that every trust has to file a T3 return. And the penalties for not filing are quite severe. And as our topic today is bare trusts, I think this has kind of been on everyone's radar that bare trusts are now going to be required to file this T3 return, which may be a pain for a lot of practitioners.
So this is interesting to me because you sort of, I think, actively avoid most kind of trust tax business. Like you're dealing mostly, I think, with like small business owners and families and situations where there's not overly complex trust requirements. I think that's a fair summary.
Yes, that's true. No, I don't really delve into the world of trust accounting or trust taxation. That seems to be a specialty all on its own. So that's not where I'm going.
So I think most people would assume that like you shouldn't care about this, but that's not the case at all, is it?
Right. Yes. I mean, I did have a conversation with a sole practitioner not too long ago, and I said, "Oh, there's new rules about bare trust reporting," and she said to me, "What's a bare trust?" She had no idea. I mean, this is not something that someone may encounter in their practice, but I have encountered it in my practice because for instance, I had a client who did a rollover. They did a Section 85 rollover where the legal title of the property never changed. I guess, I didn't do the rollover. It was one of the bigger firms that did the rollover, but because of the property transfer tax, they decided to not pay it and keep the property in the legal title holder's name, but they did up a bare trust agreement. So this corporation is sitting there. They have the property on the books, but if you look up the title, it's in the name of the individual. And there you go. That's a bare trust agreement. And that would fall under these rules.
Yeah. So this, and the trigger here is $50,000 of fair market value of the property, Elaine, if I'm not mistaken. So that's where you trigger these reporting requirements. And of course, I'm assuming with their Section 85, you're probably several $100,000 of property value.
Right. Well, if you're referring to the exemptions, the $50,000, I don't see that would fall under the exemptions, because the exemptions only apply to bank accounts, like cash, I think, and listed securities. Yeah. So real estate, you're required to file this. So
that's a good point. I was thinking it was $50,000 across all property, but it's
no.
Okay. Wow. Okay. So in this case, then, and just so you're in BC where there is a land transfer tax. I'm in Alberta where there's no land transfer tax.
Right.
Very common to see this sort of planning done to avoid land transfer tax, right? Where you keep the original beneficial owner, you have another person who gains, essentially trust ownership over that property, but there's not any further planning done.
No, it seemed to me, off topic. I thought in BC there was discussion for some time about changing that loophole, because it was basically a loophole that if you didn't change the title at the land registry office, you didn't have to pay the property transfer tax. But I thought, I couldn't really find anything about this, if they had closed that loophole, or if there's a change in beneficial ownership, you had to pay the property transfer tax. So I'm not exactly sure what the case is in BC these days.
I'll see if I can find something for the post-show notes here.
Yeah, because I know that was one of the concerns they had about, even if you're buying shares of a corporation, I think there's and there's property in there. I think there was some concern about avoiding the property transfer tax. So I'm not sure what they've done on that end. I had a client recently inquire about doing a rollover, and she was told she had to pay the property transfer tax. So maybe that loophole no longer exists.
Okay, I'll find something. I'll have some note post show here about that. So because it's a fairly complex issue, and it's variable from province to province. And I know Ontario's wrestled with some of the same kind of policy questions around that. So that'll be relevant for sure. So then where else would you see bare trusts or other trust situations where somebody might not be aware that there's a trust in place?
Well, that's where my other concern comes in. And that has to do with situations where there is no bare trust agreement, and the parties may not even be aware that they have a bare trust agreement. And that would apply to perhaps an adult child who takes on their parent to their own property purchase, maybe in a 1% equity. And, the parent is just coming on for financing purposes, perhaps, but there's no beneficial ownership. The parent is just sitting there as a legal title holder, but really they don't have a beneficial interest in the property. And what happens now? Does that mean that they have to file this T3 return or pay the penalty? Or when the property is disposed of, they would have to report a capital gain because, they're seen as a beneficial owner of the property.
How complicated is T3 filing here?
It's not complicated. It's just a matter of disclosure, really. And this kind of reminds me of the T1135, the T1135 foreign reporting that you have to do every year. I mean, there's it's a form, there's no tax payable, but the fact is, if you have foreign assets over $100,000 and you don't file, you're looking at the same kind of penalty, $2,500 a year. And in this day and age, I think I've been in practice 15 years, and as far as I know, this has always been a question on the tax return, but I still encounter people who are unaware of this T1135 requirement. And yes, and then we have to go and do a voluntary disclosure. And yeah, it's kind of surprising. Well, some people do their own taxes, so how would they know?
And the T1135 questions are like, there does seem to be some exceptions there that may not apply when push comes to shove. I think with the T1135, I think that might end up being the same with the Bare Trust reporting.
It's possible, yes, but I think as far as I know, this Bare Trust reporting, and unless perhaps they exempt individuals, I don't know if that's on the radar, or are they requiring everyone, like say a parent and a child? That would make our lives easier. But
so, and it's the filing here. Now, I agree with you that T3 is fairly straightforward, but we're going to be required also to indicate the full set of beneficial owners for that trust, aren't we?
Yes, that seems to be the case. And I guess it's been suggested that it may be hard to get this information. I mean, in my own client base, I can't see that I would have too many situations like that, but I have heard that maybe it would be difficult to track down all these beneficiaries. Maybe they're overseas, maybe they're non-resident. So that's a possibility as well.
Yeah, could be minors where you don't have a connection with the parents, for example. I could see that being a potential challenge here, where you brought the grandkids or great grandkids into your plan and had to bypass the parents for whatever reason. I know this happens sometimes. So yeah, I don't know. I just don't think that we're prepared for the level of complexity with this, or the number of unintended outcomes. So now, you mentioned already, just going back to where you see this in your practice, you talked about the sort of combo of people buying a house or owning a house together. What about with bank accounts, that kind of thing?
Yeah, I mean, that's fairly common too. You have an adult child who is taking care of an elderly parent, and, the bills have to be paid. So the adult child will go into the bank with the parent and, okay, say, put me on her bank account. And there you go. I mean, she's probably not intending for it to be, that's her money. There is like a joint bank account. She's saying, no, I'm just holding it in trust for my mother. I'm just managing the money. I know that can be quite complicated when it comes to filing the final return and going through probate, because I've heard of cases where someone passes away and there's an adult child on the bank account, and suddenly the adult child claims, no, that was a joint bank account. Me and mom, we decided that would be my money. And then the other children come and say, no, that was a bare trust agreement. You don't have beneficial ownership of the money at all. And, that can be a source of contention when settling the will.
The Pecore estate is, of course, the famous example of that, where it wasn't actually it was the child's soon-to-be ex-spouse who made that argument that was
right.
Now so it, just another layer of complexity with that fairly common arrangement, right, where you have the kid on there to help manage the account. So
well, there is that $50,000 exemption, so I could see they're trying to weed out circumstances like that, but they said if at any time in the year the balance goes above 50,000, then you're outside and now you have to file the T3. So what if mom sells her house and the money hits the bank account for a short period of time before going into a GIC? Then suddenly you're both on the bank account, and that's a bare trust agreement, and you have to file.
That's information that CRA would have relatively easy access to. I think that's yeah. So okay. This is a lot to process, honestly. I'm just thinking about the number of situations that you run into where, like this is a good example. The bank account creeps up over $50,000 for a short period of time. I think that most people would assume that your tax filing obligations are based on what's true on December 31st, or, you know, some, like, that's a common enough tax rule.
Mhm.
So that's wow, that's tough. Okay, so then with your clients, how are you going to address this? What's the, like, how does the accountant, and this, you're dealing with people who are getting, you know, good professional tax advice. So can we start there? How are you going to address this with your clients?
Well, I've already been preparing them, because at first we thought this was going to be taking effect at the end of this year, and the filing required by March 2023, because of course trusts have a year end of December 31st, and the filing has to be done within 90 days. So I have been, some of my clients, I have been asking them, hey, you know, this is coming up. Do you have any sort of bare trust agreement, whether you know it or not? Because as I said before, there's not necessarily a written agreement. I mean, it seems like back in the 80s or 90s, this was a big thing, putting your kids on title to your house. I still have clients come to me and they say, I have a great idea. I'm going to put my child on title to my house. And I think, no, stop. Why? But I think perhaps in the 80s or 90s, probate was a big thing about avoiding probate fees, and they all seem to think this is great to put your kids on title, and then you could avoid probate fees when you pass away. So for estate planning purposes, I think it was, you know, it was easier than it is now, because all of this reporting around real estate, it's not something you can just kind of sneak in under the radar and not say anything and hope nobody notices.
Yeah, I think about this, like, there's all these cases, you're right, avoid probate. There, you talked about affordability before, so the kids can't get on the mortgage by themselves. And that's our case. Like, I'm on title with my daughter on the house that she lives in, because she wasn't going to qualify for the mortgage on her own.
Right.
So
right.
yeah, so I know we have to figure this
There
out,
you
right?
go.
Yeah. So that's, you know, that's a good example. I talked about that on a previous episode, actually, about helping her buy a house that way. So
Mhm.
that's, yeah, I don't know. You know, I see it sometimes with financial accounts, like you said, where it's that control issue. These are, you know, like, are you going to have a questionnaire where you say, are any of the following 10 questions, which might seem like none of my business, true? Is this kind of how you address this, or
Well, I think
what's
we'll
the?
have to, in order to really do our due diligence. I don't see how we can avoid the issue. I mean, I have had clients who recently had children, their adult children buying houses, and I'm asking them, oh, are you on title as well? and you
Yeah,
know, this is not something that generally comes up when you're doing your year-end tax filing. You know, they just say, oh, so and so bought a house, and they don't really mention that they took a 1% equity ownership of it, or whatever. So I don't, you know, I see this is, maybe the tax filing will be a lot more complicated, and you know, just have to spend more time with the client asking them these questions. But you know, it's gone that way so far as well, because you know, we have to ask them about their foreign assets, and sometimes that doesn't come up either. Like, you may have a client and, oh, you didn't know that maybe she has a bank account from when she left her country 20 years ago, and she's maintained that, and oh, surprise, surprise, it's over $100,000. And
yeah, that's, I mean, the difference there is that if you sort of accidentally have, you know, over $100,000 of property, CRA is, I think, less likely to become aware of that. Not impossible, right? Like, and I'm not suggesting that we shouldn't report. We have to properly deal with that T1135. But here, I think you're just going to run into so many more cases where CRA can fairly easily get access to the information that's going to, you know, trigger a reassessment or trigger this penalty. So
yeah, I mean, the penalty, that's the scary part, the 2,500 a year. I mean, you go a few years, 2,500 a year really adds up.
yeah.
So
Yeah, $25 a day maximum, right? Is it 5% of the value of the property to a maximum of
Well, there's I see they've added a gross negligence penalty in there, which is up to
Yes,
5%
yes.
of the fair market value.
Right.
So I don't know what they would consider to be grossly negligent and would require this penalty, but of course, you never know.
Yeah, I don't know either. As you said earlier, the common trend there is to assess the maximum sort of imaginable amount and go from there, right? And let the taxpayer argue it back down. So we'll see.
Yeah,
That's a
yeah,
tough one. Yeah.
yeah.
And I think then about, the number of, like, for your clients, they're going to be, I think, well served here. But you look at the number of people who, use, not to pick on TurboTax, like who file with TurboTax or file with Wealth Simple Tax or whatever, is, I don't know, are those programs going to be able to sort of ask enough questions to make sure that people file their T3? And then is it going to feel intrusive? Like, I think sometimes when you're using those kinds of services, you answer yes to the question and it says, oh, congratulations, you have to file a T3. We need another, whatever it is, $300. Like,
I
Yeah.
know. I can see that. Yeah, I don't know. Well, I'm an accountant, so I think people should use accountants because, this is our lives. Our lives is keeping up with tax updates, and you may not know everything if you're filing your taxes on your own, though, people do it and they don't run into any problems, but I would hesitate because there's so much unknown like this, who would have thought this is going to trigger a T3 filing requirement?
Yeah, I think this is a tough one. Now, I know we're not really here to talk about tax policy. Like, that's not your forte, but I'm wondering, do you have a sense for what the policy reasons for this are? What's the benefit going to be of adding this complexity to, individual taxpayers' lives?
Well, I think, the government has been under fire recently for, money laundering, and, we don't really know who owns different properties in Vancouver. We're always, speculating who owns that $31 million mansion, and you look it up, oh, it's some numbered corporation, and where did they get the money from? So in BC, we have the land ownership registry, transparency registry. And I know the lawyers in BC were busy filing all those reports to the end of November 30th, 2022. That was the deadline. And I can see it's got some elements of this because Bear Trust, as I understand, had to file this as well. And I did read somewhere that, it was the same thing. If a parent has a stake in a child's property or as a Bear trustee, then, they were required to file this, but I don't know, that's not my expertise, but it seems to me it's a common theme. Real estate is such a big part of our economy. How could the CRA not go after situations where people are not correctly filing?
Yeah, it's an impossible problem to solve without, it's like any tax policy. You can't just target the people who are doing wrong. You have to cast a wide net and then figure it out, right? So yeah. So any advice for the financial advisors, financial planners who would be listening to the podcast? What should they be doing here?
Well, if they have clients they know who are in these situations, definitely make sure the accountant is aware because, perhaps the accountant isn't even aware that this structure exists, or they've got different people listed as a title holder. So yeah, I think that's very important.
Do you have a sense of roughly what it's going to cost to file the T3 here? Like, if I'm, already paying an accountant to do my normal, let's say self-employed tax returns, do you have a sense for what
I don't know. Like, I wouldn't want to comment on that because every practitioner is different, of course, and they have different fee structures. And we haven't seen I hear there's a new schedule that's required for this T3 reporting. It's a Schedule 15, I think, and it's going to require you to list all the beneficiaries and their social insurance number and address and tax jurisdiction. So yeah, it's hard to say.
Yeah, I think that's a fair comment. I just, it's going to be one of these things where the financial advisor says, client, you got to go deal with your accountant. You're going to have to, or you've never been using an accountant. It's time to get yourself an accountant to make sure that, because the consequences of not filing are significant here. It's not like this is one you
Yeah.
just let it fly. So yeah, I really think that this, and as much as I hear, like most accountants I talk to are, I think, similar to you, Elaine, not a huge fan of the outcomes for their clients. I think that's probably fair.
Mhm.
But I think it's going to drive more people to go. I hope it does. I hope for the financial advisors, financial planners listening, that they will, go and develop relationships with accountants that they can then send their clients to make sure that this is properly handled. I think the number of questions that have to be addressed here properly to make sure that we're reporting this without incurring penalties. I just don't see how this is going to be something that you can manage yourself now.
Yeah, I don't think so. No, not as it stands, unless there are some changes that are coming that we're unaware of. Like maybe they're exempting individuals and only corporations or partnerships have to file this. I mean, we'll see how it plays out, I guess. But yeah, I think it's quite an issue, and I think bringing awareness to it is something we need to do over the next year, since now we have a year to think about this and gather all our information.
In light of that, I am grateful you reached out to me about it, because I think it seems so innocuous, or it seems like most people shouldn't be subject to it. But we talked about 3 fairly common circumstances, right, where this is a real thing that could show up, right?
Yeah, definitely. And then people would just be unaware at all. I mean, if there's no written bare trust agreement, then how would you know?
Yeah. And this is a good point. This is something we haven't addressed, but having a written bare trust agreement makes it obvious that there's a bare trust, but you can easily have a trust, which we normally call either constructive trust or resulting trust, where nobody ever wrote anything down. There's just,
yes, exactly. Yeah.
There's a trust arrangement in fact, but there's not one on paper. There's still a
Right.
trust there, and CRA is still going to look at that as a trust.
Yeah, right.
So yes, this will be interesting. It'll be interesting in cases. The one that I see a little bit in some estate and insurance planning is cases where it's retroactively determined that there was a trust, right? So then I don't know. It'd be hard to argue gross negligence there, I think, maybe, but the base penalty, like, is CRA going to go comb through cases where the judge decided that there was a resulting trust and then retroactively apply tax there? So I don't know. This seems I don't know.
It's pretty scary, I think.
Yeah,
because we don't really know. Yeah.
So so I do want to encourage, like, for the financial advisors, financial planners listening, treat this as a sort of bridge to your client's accountants. I think that there's something there, and I think this is true, Elaine. You want to hear from the financial planners and financial advisors, right? You want that bridge in place. Is that a fair comment?
Definitely. Yeah. I mean, most of them I do communicate with them, for purposes of getting the capital gains report or getting the slips, the T3s and the T5s. But in terms of the actual planning, sometimes we don't really know what they're doing. We get the filing slips at the end of the year, but we're not really privy to what the big picture plan is, and maybe they've set things up that we're not aware of.
Yeah, that's perfect. Okay, well, any final comments or thoughts about this, Elaine?
No, I think we've covered it all. It sounds.
Yeah, I think so. I'm really grateful for you reaching out about this, because I honestly probably would not have sort of thought about the scope of this. And I listened to, I'll put a link to this in the show notes. I wouldn't have thought about this affecting individual taxpayers so much. Kim Moody talked about this on his podcast.
Yeah.
But he really focused on, like, land developers and bigger issues. Like dollar amounts where those people should be dealing with a tax professional unquestionably, right? And I think, like, that's relevant. But here we've talked about, and again, just to recap, we've got the person who buys a house with their kids for affordability, the maybe older person who brings their kids on to bypass probate or create some simpler estate outcome, and then the sort of control over the mom and dad's bank account. And then you rightly talked about the Section 85, where I think that's going to be a less common case, but where the corporation owns property in trust where it's still in original title. That's going to me, I don't know, maybe I'm misreading that, but I think that's going to be a less common case, and one where there was a Section 85 clearly with the tax professional involved, right?
Yeah, and there's a bare trust agreement, and the lawyer is aware of that. So, I think the lawyers may be, notifying the accountant that, hey, this has to be done. I don't think the lawyers would be interested in filing these returns. I mean, they are a tax return, so I can't see them delving into this, but they are, right now they are doing their land ownership, like in BC, the land ownership transparency registry. So they're familiar with it at this point.
Yeah.
But
that's
the tax filing,
the tax, I'm sure that lawyers don't want to be doing tax filing.
No.
So yeah. Okay, well, that's awesome. I really appreciate your time today. Elaine, any parting words for us?
No, thank you for having me. I think it's a good topic, and I just really wanted to make the financial planning community aware of this filing requirement, because it will be important going ahead. And of course, we strive to avoid penalties whenever we can.
Yes, and that's a good point, right? Is we don't want to put our clients in more difficult situations, and I just don't think that there's a head in the sand approach that's going to work here. So thanks very much, Elaine.
Definitely.
Have a great one.
Thank you so much.
Okay, one of my favorite things to do is learning, and I got to learn a lot in that interview, which is great. That's why Elaine reached out to me, because she knew that there would be a bunch of folks who hadn't fully considered the implications of those tax changes. I suspect we'll get a fair bit of discussion about that over 2023. My concern here is that we don't want to have this mad scramble for information late in the year. I think that especially if you have clients who are going to be impacted by this, they're going to have to go and engage with that tax professional. And if they're not currently using a tax professional, that could be a little bit of an implementation challenge here. Because I know for me, I use a sort of mid-sized CPA firm in the city here. And my tax return was a little bit complicated. The last time I paid for returns to get done, I think I'm going to have to stop doing this now, but I DIY my returns in my simple years, and then I pay Jonathan Whitmore, my accountant, to do my returns up in the more complex years. The last time I paid for returns, it was $800 for my wife and I. So folks might have a struggle with that. Now, that was a little bit of a complicated return, sale of a business and all that. So I don't know. All right. We talked in there about land transfer tax, and there's a lot here. So BC does have a land transfer tax regime. I've included links in the show notes. But yeah, Elaine mentioned this exemption where if you don't file, you don't pay, or sorry, she said she thought that's gone, and she's right here. There's no exemption for that. There are exemptions for a whole bunch of sort of family situations, but they all have specific criteria. So I'm looking at the exemptions for BC for land transfer tax. There's a really long list of exemptions here. Every one of them has a 3 or 4 page document that gives the exact criteria for those exemptions. But a lot of exemptions that happen within the family unit where there's no trust or estate involved are going to allow a bypass or some limited bypass in some cases. So an exemption, that is. So that's something to watch. That's going to be different in other provinces. And this is why we need to use a real estate lawyer to do our transfers. And just like every other kind of legal arrangement, we want to make sure that we're using a qualified lawyer, one who's going to know the rules here, who's going to say, yes, that's going to have land transfer tax, or no, that's not going to have land transfer tax. And I find this is one of these areas where there's quite a few folks who dabble and I would prefer to deal with the qualified lawyer who is going to do these types of transactions all the time. And I find this is common in a sale of a business or a sale of a house, sorry, when somebody goes and buys a house on the market and deals with a real estate agent, then they're going to get connected with that real estate lawyer. But where people do these transfers sort of within the family, they don't necessarily think to take that step. So again, we're asking for money or professional advice here. I think we have to acknowledge that there's going to be costs to these transactions. Okay. Elaine mentioned the Schedule 15, the new version of the Schedule 15, and I believe she's right here, but it's not out yet. So we'll keep an eye on that, but there's nothing useful I can show you with Schedule 15. And then I'm including a link to a blog on the CPA Canada site, which lists the exemption. And Elaine rightly talked about the most common exemption you're going to run into here, and that is trusts that have less than $50,000 of assets, but that's restricted to really cash or cash type assets, as well as securities. So deposits, government debt obligations, and listed securities is the actual $50,000 threshold here. As she rightly mentioned, no exemption for real estate assets. Other exemptions to the new reporting rules will be trusts that have existed for less than 3 months, mutual fund trusts, segregated fund trusts, and master trusts. These trusts are all filing tax returns anyways. Trusts where all of the units of which are listed on a designated stock exchange, that's going to be things like REITs or income trusts, other kinds of income trusts. Trust governed by registered plans. Again, all of these kinds of commercial trusts are going to file returns anyways, or some sort of return. Employee profit sharing plan, lawyers' general trust accounts. The one that might be impactful here, because we're already getting returns filed for these anyways, graduated rate estates and qualified disability trusts, these don't have additional reporting. They're still going to have their normal reporting required. I talked about those both in the intro comments. Trusts that qualify as nonprofit organizations or registered charities, that's good. That's a nice exemption. I'm hoping there's not a money laundering opportunity that shows up there, especially with NPOs. Employee life and health trusts, certain government funded trusts. I'm not sure exactly what that refers to, but that's the government's business. And then cemetery care trusts and trusts governed by eligible funeral arrangements. So we have a fairly long list of exemptions, but nothing that's going to change anything that Elaine talked about in the interview. I just wanted to take a minute too to acknowledge something kind of cool that happened here. So I had back in season 4, episode 26, I had Paul Rubner on. This was anti-money laundering in real life. Some of you might remember Paul was the former City of Calgary vice cop who had gone on to co-found a charity that gives backpacks to mostly women emerging from human trafficking situations. And it given the link to donate to iWin, that's the organization that Paul represents. And somebody made an anonymous donation, so that's awesome. Somebody tagged like the podcast in their donation, so very cool that happened. Really appreciate whoever that is. Thank you so much, very generous. And it is, as I'm recording this, actually we're just a week from Christmas, and a great time to sort of see that kind of news. Anybody listening to this or listen to this early in the new year, so Happy New Year. I hope everybody had a wonderful holiday season, and I'm already recording episodes well into January 2023. So enjoy your continued studies, and thank you very much for joining us.
Hi, if you're listening to this episode and you're not already signed up for CE credits, this is a very easy thing to do. Just navigate over to businesscareercollege.com and you're going to sign up here for CE. Just subscribe. Currently, the pricing is $200 a year. We may be introducing monthly pricing at some point, but as of today, we have a cost of $200 a year. And once you're signed up, then you can just go and listen to every episode within your subscriptions. So you'll use once you're logged in,
you'll use my subscriptions here, and you'll just go to the latest episode, which you'll scroll down to very near the bottom for. It doesn't matter which episode, you just scroll down and you find the one. So as of the time I'm recording this, the most recent episode is season 4, episode 27. I can just start it right from here. I can do the quiz here. Once I'm done the quiz, then I can get my continuing education certificate. Very straightforward. So I would just launch the course here, and I can watch the episode from here. Now, if you happen to be already listening to it on YouTube or whatever the case is, you can just navigate right into the quiz. You start your quiz, and you're just going to go through the whole thing. And then at the end of it, you'll be able to see your certifications. So we're going to bring up designing small group products. We bring this up and we click on wall certificate, and that's going to give me the CE certificate I need in order to maintain status wherever I happen to need CE credits. So I really do encourage, I know that out of our regular listeners, about 40% of you are listening to the episode for CE credits. That's about 60% who are listening out of general interest or whatever it is. And I really think this is an easy way to get your CE credits, $200 a year, pretty reasonable price. And as you can see from the certificate here, and as you hear me discuss at the beginning of the episode, we have a broad range of approvals for all of our courses. I'd like to thank Joe Tong. Joseph is our editor, both for video and audio content. And Joe does a lot of good work to make sure that these episodes look and sound good, despite my better efforts. I'd like to thank Maria Nguyen. Maria makes sure that the episodes all get approved for CE credits. Veronica Thibert does the quality assurance through that process. And then we have a strong marketing team that makes sure that all of our content gets out there so that people can find us and take advantage of the learning opportunity they might not have known about.